All right, we have some industrial production numbers coming out right now. Just a little heads up, if you guys can hear me. Data flash. Oh, it looks like they came in a little bit better than expected. That's and capacity utilization came in better. As you guys have probably seen, the dollar is just ripping. The euro is just, floundering. Aussies at new lows. Yeah, we're just seeing the dollar just, rip higher everywhere. We were just in the chat room, and let's talk about something really quick, because I want to tell you guys what especially for those of you that are not in the chat room. Hold on, let me make sure everybody knows. I was going to say that we were just having this conversation in the chat room, and I have to reiterate to you guys, I'm about ready to get stopped out. I took a little euro dollar long at 50. What I should have done is just taken my quick like 7 or 8 pips when I had them, and I didn't, because I threw my stop below. It's like my stop's like literally 5 pips away. I'm not risking much. But the thing is and this is what I was saying here in the chat room, is I have a bias. Do you guys know what my bias is regarding the dollar? John says, "Oh, is trading contrary?" No, no, my bias is long dollars, right? Well, I mean, the dollar is bullish. It's bullish. Like, I know it's bullish. I know it's breaking out. I know it's holding up well. I know it's, it's being bullish the dollar. So my bias is being long the dollar. So why am I trying to buy the euro today? Like, I was trying to be cute, and I'm like, oh, look, previous resistance, current support. So, I'm just going to go ahead and get long the euro here on a, look for a bounce, and just play it on the long side just to be cute. And so what happens here? Well, I'm going to get stopped out here in about 4 pips, 3 pips. And then the problem is that I have some decent gains from overnight. I end up giving back some of those gains for why? Because I was trying to be cute and trade in both directions. So that's stupid, right? Especially if you have a bias. For me it is, and I'm not saying it's right for you. You guys do whatever you want to do, and I will tell you this: some people are way better going both ways than I am. You know who you are. I bet you like it both ways too. Just kidding. No, but seriously, jokes aside.
Steve is not on the webinar, so that's not funny.
Steven, yeah. No, but jokes aside, though, I mean, some people are really good at trading both directions. I am not. I already know that. That's like one of my weaknesses as a trader. Like, you should be able to identify what you're good with and what you're good at and what you're not good at. And one of the things that I've identified over the last 20 years is I am not good at trading both directions. And I'm very clear on that. If you guys have been part of the ForexAnalytix community, or even prior to that, MB Trading, Wise Trade Group, I've been very vocal about that for at least the last 15 years. I'm like, dude, I'm just not good at trading both directions. I'm just not. And that's why I tend to be biased and stay biased. So, and that's why when we go through this bias chart, one of the things that I hate the most is when everything says range. Again, you guys that have been listening to me for 5, 10, 15 years and watch me do the bias chart every day for, you know, at least let's just say over 2 or 3 years and longer, you're all going to say the same thing. Oh yeah, Blake hates it when everything is yellow. You know, I love it when everything is biased, because I can say, oh, you know, it's going in the direction that I feel, or, oh, everything's going counter trend. I just need to stand aside right now. But I'm not good when things are going counter trend based on what, if I end up getting avoided on the stop, I'm going to be really quite shocked. My stop is at 29, just so you guys know. I bought the euro at 50 and I put in my stop at 29. And I've come within just maybe 1 or 2 pips of being stopped out thus far. I'm assuming I'm going to get stopped out. Anyway, what I'm trying to say is that I tried to be cute today, and realistically, I'm going to end up giving back some of my gains, which I made some really good gains overnight. You know, and that's the frustrating thing is I had a very, well, for this time of year, and I had a very aggressive short Aussie dollar since last week. I was trading a little bit more aggressive than I normally do. So, you know what I mean? So that's good. I mean, I'm just kind of irritated because I'm like, I'm going to end up giving back some of those gains, you know, today, I think. Unless I get lucky and the Aussie, you know, and the euro bounces back to like 117.60 and I can just get out of it and, you know, scalp out a little bit of a gain. But anyway, so what's the moral of the story today? The moral of the story is know your weaknesses and, you know, try not to be cute, especially in the summer months, and especially when volatility is super low. It's, you know, you get cutesy and then you get yourself in a little bit of trouble. Now, fortunately, like I said, for one of the reasons why I felt like taking the trade too is I made a pretty substantial gain overnight. So it's like, okay, well, I can take on a little bit of risk, but that's stupid. Why would I even do that? You know what I mean? Well, why am I even doing that? It's like, why don't I just retain my gains and then walk away and, you know, not be quote unquote cutesy today. But anyway, I wanted to have those conversations with you. You know why? You know why I'm going to have that conversation with you right now? Because no one else will. And you can take that to the bank. Okay. Anyway, let's go through the analysis here. So let's start with the euro. Speaking of which, so the 50% retracement is holding, right? And that is going to be, I was really hoping we'd get up to 118.30. I know we were talking about that yesterday, is hoping it'd get up there to be on the short side. Fortunately, the euro just, you know, is rolling over. The dollar is strong, guys. And, you know, again, I will continue to reiterate this. If we ever see any type of risk aversion, the dollar is going to come out of its shoes. Like, you know, you're going to be sitting here looking at the dollar and you're going to be like, oh my God, the dollar, I had all day long to buy it at 93 and it's trading up at 96. That's going to happen if we see any type of risk aversion hit the market. You know, I mean, they're going to shove this dollar short trade so far up people's rear ends, they ain't even going to know which day it is. Brand says, oh, you do that to get a thrill because you're bored. No. I was, it was mostly because I tend to trade a little silly, and I'm going to answer this. I'm going to go back to what I was saying, or go back to the analysis. I tend to be more, I don't trade because I'm bored so often. I trade because I do stupid things because I get overconfident. That's where it really comes from, is whenever I go on a streak where, and by the way, for summer trading, I've been doing really well over the last like month. You know, it's, you know, I mean, I've been buying dollar dips. And so it's worked out really well. So like being short the Aussie the last couple of days, it's like, okay, you know, it's gone far enough and I'll trade counter trend. You know, I didn't want to buy the Aussie, but I'm like, okay, I'll buy the euro. So I tend to make those types of decisions coming off of really good runs or really good trades, right? Anyway, yeah, I mean, you know, and I've absolutely been crushing it with dollar Norway, just buying this thing on dips every time it comes down into the 70 cent, lower 80 cent level, spinning, just buying it on dips and selling it out. This has been one of my better trades just over the last couple of months, playing this breakout here and then buying every dip down here basically has worked out really, really well. So, you know, the dollar Norway is one of my favorite currencies to trade and has been for years. It's a really good trading currency. I like it. I think there's a lot less algorithms attached to it too. Anyway, okay, I'm sorry. I'm going to continue on. So I know Stelios is like any day now. Let's wrap this up. Okay, so 118.10. I know, right? Huh? Support's going to be 117.25 and then 117. So I don't think we're going to see that today. Okay, let's go over to sterling. And by the way, we should probably just keep that bearish because it is. Sterling, channel support comes into play right here, 137.50. $137.50, right? I am going to keep this in range. Resistance will be 138.60 now. Actually, by the time we get up there, if we get up there, it'd be 138.50. So just whoops. Keep that in range. Aussie is obviously bearish as we make new trend lows. No doubt. I thought we'd get some sort of bounce here. Now I'm a little irritated that I am not long or not short Aussies. Let's see. Let's do this. So the 127% extension of the flag basically comes in at 72.50. So that's going to be pretty key support. And then any move back up to 73.15 because that was the channel from yesterday, right? By the way, if you guys aren't in the chat room, you haven't heard this. We had a bad. Our monsoons have been really bad. I had one tree that got ripped out a couple of months ago completely, and then I have another tree that's. I mean, it must have been 4 or 5 stories high. Like it's tall. Like it's an old tree. It is falling, and the problem is it's falling on my fence, and I have to go tear it down. It got ripped. Like the roots are ripping out of the ground, which is crazy because we've had so much rain here. And I live in the desert, so we had so much rain that it's actually softening the ground to a point where it's making these trees vulnerable, which sucks because it was a pretty tree that provided shade for my my pool, and that's going to be gone. So it's actually, I'm kind of bummed out about the whole thing. I found out this morning about 3-4 hours ago. I went outside and it's dark, but I'm like, oh, I can see like stars where I normally can't see the stars. And then I turned on the flashlight and I'm like, oh crap, my tree is like literally getting ripped out of the ground.
These are first world problems. You'll realize that.
Yeah, I know, but it's like, I mean, it's a beautiful tree. It's like, I hate to see that, it's
Yeah,
like,
of course.
yeah, it's,
I'm just
and
messing
like,
with
and you guys know, it's 1,000 degrees here in the summertime. So that pool, it provides us shade that's not going to be there anymore. And, it kind of sucks. Anyway, a little bummed out about it, actually. So the Kiwi support is coming in. I mean, this is all major support down here. So, you can see we're finding I would not want to be short down here, not ahead of the RBNZ, even though I think the RBNZ, the risk is that they are dovish. I'm just saying that you might get a little bit of a bounce. People are going to start, anybody who's short is going to be thinking, okay, I need to cover this up. Right. So, 69 cents, 68.80. I mean, we'll write that down. 68.80, and then resistance is going to be back up here. Well, 69.70 and then 70 cents. So I'll have to write both of those down. 69.70, 70 cents, and I will keep us in range there. Even though we're at the lower end of the range. So, by the way, there was some of the banks were pretty bullish on the dollar Canadian if we got above 126. I mean, we're trying to break out here. So, dips back to 125.75 will be very well supported today. We might get a rally back to 126.60. Okay. I am about ready to get stopped out of the euro. I'm just a couple pips away. So take my 21 pip stinker and be done with it. Swissy, 91 cents. That is the 618 retracement. That is support today. $91.50 should be resistance. I don't think we're going to make it past that today. Could we spike up to 92? It's possible, but I doubt it. Keep us in a range. Dollar Norway looks good. Right up against resistance here. Resistance will be 888. $877 is support. Now, obviously 870, but while we're above those levels, we have to remain bullish. Dollar MEX. So we're struggling here at 20, but if we can break through 20, that'll take us right back up to 2020. So I think, or 20. This is, remember, the 200-day moving average is probably like at 2010 right now. Is 2011. So 2016 would be good resistance. So I'll go back to the 4-hour chart. So I'm going to write down 1980, right? And then 2015 range. Dollar yen. Speaking of range. Wow, you have to get stopped out of the euro, yet. Surprised about that still. There's a lot of support down here. I mean, if you look at just, go back through beginning of summer here, look at all this support that's through here. This is a lot of support. So anywhere from 109, let's just call it 109.10 to 108.60, just a lot of support. So I'm going to write 108.60. I think you'd have to consider yourself very lucky if we got down there and you got an opportunity to buy it down there. 109.10. So what I'm saying is, basically, if you get anywhere down here, it's probably a really good opportunity to be on the long side. Just a lot of support. This channel will come into play, whether, it could be through the wicks by the time we get there. Could just be channel support. So there's going to be all sorts of support down here. I wouldn't want to be short down here. Just put it that way. Dollar index, we make it through that resistance. So obviously 93.20 is resistance. Support now, the 50% retracement's big. So we should respect that. Let's get rid of this right here. Okay, so support is at 92.50, resistance is at 93.20. Oh shoot, I forgot to do the dollar yen resistance. So dollar yen resistance would be right back up here at 110. And then dollar Norway is coming off pretty good right now. Dollar Canadian is too. Crude just ripped. Gold, silver, Bitcoin. So gold, made it above the 1790. I usually don't pay attention to a 200 period moving average on a 4-hour chart, but if you look at, just like look at a little bit of history of this 200 period moving average and just kind of see what's happened around it, it kind of makes me think that, we might have to respect it a little bit here. Do you see what I'm talking about? Like, notice how we hug it over here. We get it near it. We hug it again over here. We did it again and did it again. So I don't know if it's going to hold today, but I think we got to just recognize the fact that the 200 period moving average on this 4-hour chart is actually worth something at the moment. I'm going to note the resistance at the 78% retracement, which will be basically 1800. I'm going to put gold back into range versus bearish. I think support at 1780 should, find some buyers, but I just think you got to be a little careful around. If you're trying to trade gold around this 200 period moving average, just be a little careful. Silver, silver can't break 24. That's, oh, you know what? I had gold in range. It was silver that wasn't. So silver is, we have that in bearish, and I think it should remain there. 2340 support. Spike low from yesterday, I think, or no, 2 days ago. Yesterday, yeah. So we have to note that. And then Bitcoin. Has anything changed? Nope. 48K. 42.5. It's bullish while we're above that. And guess what? The S&P is probably at support right now. Why? Because remember 4440 was the 127% extension. See how many times we knocked our head up against that before we finally got above it. So I'm going to write down that that's support intraday, but really it's, you know, obviously 43.75, but I'm going to write down basically 44.95, which is 4,500, and we're bullish. Okay, there we go. Trend line resistance is somewhat holding. So from what I understand, Steve, who's on vacation, is here today. So Steve,
I see the bias chart again, please, Blake.
No.
Okay.
You got to ask.
No fun for you.
Steve, you sound like you're gargling in water.
I do.
No, he's okay. You're okay. I think you're okay.
You did for a second. You're like a little jumbled up. But there's the bias chart.
Really?
That's because he was in the sea, basically.
Yes. I'm broadcasting from what was the book name? 20,000 Leagues Under the
Sea.
20,000 Leagues Under the Sea. Yeah.
Yeah.
There you go. You did sound like it for a second.
Yeah, he did.
So hey, I've got to go. I'm like I was just saying, I've got to go assess damage with this tree that just got ripped out of my yard, which is such a bummer. Oh man, I'm like really bummed out about all this. Anyway,
it's okay, Blake. We got it.
All right, I'm gonna let you guys take it. Have a good one, everybody. I'll see you on the daily roundup in a few hours.
Thank you, Blake.
Thank you, mate.
Thanks, guys.
Okay, so what's changed since FA.C.E? Not much. The markets have opened. Equities are a little bit lower again, but you know we saw that movie yesterday. Let's see how it ends. Commodity currencies have been all day on the back foot, led by the Kiwi and the Aussie. Interesting thing to note, which we didn't talk about on FA.C.E, was that we got UK average earnings index plus bonus. Are you sitting down, Steve? Plus 8.8%.
Nice.
Year on year. So basically, this is transitory, right? I mean, and I'm actually reading and excuse me, talking to friends, and the high-end jobs like banking, legal, and stuff like that, they are getting big double digits increase, especially on entry level. Like I have quite a few friends in banks still, and they're saying that analysts and associates who start from school, from university or business school, the base salary is going from like I don't know, 80K to 100K, stuff like that, which is big. So
it is. Yes.
So inflation is here. It's going to stick with us for a little bit longer than people think. That's my view. We are getting some mixed data. We got the US retail sales, which was weaker. We got Eurozone GDP at 2% quarter on quarter, as expected. So it's a mixed bag. But anything inflation linked, CPI, PPI, earnings, they're beating on the high side as a not all of them, but as a rule. So it's interesting to see what the Fed's going to do. Today's mood is a bit more somber than other days, than recent days, because of the Delta variant. Everybody's remembered it now, and New Zealand is back on lockdown for one case or two cases or something like that. And we all remember what happened in 2020. And I don't think we're going to have the same thing. But governments are always going to they're going to err on the side of caution, and central banks too. And I think we have a very big kind of binary event now in a few hours at the RBNZ. It used to be a certainty that they're going to hike 25. Now it's probably not. You had banks, I think ANZAC, actually I can't remember, one of the antipodian banks said that they're not going to hike now. So it's definitely going to be interesting. And speaking about hiking, I read that JP Morgan is now bringing forward their estimates or projections for hiking from the Bank of England. So that's another one to watch. But overall, hawkish tone is spreading. It started with Canada when they started tapering. It went on with the RBNZ. Norges Bank is expected to hike later this year. And we're seeing now more and more Fed members talk hawkish. We're seeing banks saying that this is going to be, the Bank of England is going to be hiking sooner. So this is the prevailing theme. The only instrument that kind of hasn't got the memo yet is bonds. Yields are still lower. 10-year US is 125. The Bund is getting close to my 178 target. I really hope we see that again so I can short it. But overall, bonds are the ones that are really not caring about anything at the moment. And unfortunately, bonds are going to be leading stocks as well. So at the moment, I have
as I said before, there is supposedly an argument that perhaps, the bond market is so far ahead of what's happening that it's already pricing in
the reaction afterwards.
The reaction after a tightening cycle begins. Yes.
Yeah, could be. Yes.
My counter argument to that has been and remains that in order to accept this, you need to make the following admission: that the bond market suddenly jumped in being 2 moves ahead, if we want to use chess terminology, right? Because it never priced in the initial step of getting closer to hikes. You know what I mean?
Yeah.
So
well, maybe because the scope of tightening is, if and when they start tightening, the scope is going to be relatively limited. So maybe the markets are thinking, we're at 125 now. In 10-year, we might get to 150 or something like that. It's within the recent range, or 160, and then we come back down. So they're like maybe they're thinking what you're saying. I don't know is the answer. All I know is that for all the years that I was working at the banks for 10 years and I was sitting close to the bond traders, man, they were one step ahead. They usually were.
No. I don't. As a general premise, I don't disagree with that, Celia. I don't. Yeah. But on the other hand, I always have to keep in the, on the side, the obvious reality that, like it or not, the bond market is and has been for many years a heavily distorted market.
Yeah, true. Okay. Let's, I don't know if you want to show something. We don't have any questions yet.
Yeah. Well, I have a few things to show. So perhaps because of what you're saying, we've got this big move lower in the Kiwi intraday, right? I just changed, as you were speaking, my charting on the Kiwi. I think that ahead of this event risk now, with the progression of price action, I think it's better to look at it as a rectangle, and we're currently testing support here at roughly 69 cents. We're still within a bigger descending channel, and a breakdown from there would target 67 cents, which is more or less the confluence of the 78.6% fib from this last move higher with the channel's trendline support. So that's what I would be looking towards if we break through that. We spoke yesterday about the rejection Aussie had from this channel trendline resistance, and also I spoke specifically yesterday about what appeared to me to be one of the few technical opportunities, clear technical opportunities in the FX world, which was the Aussie yen breaking through this little pennant, and we are seeing follow through today, and the Kiwi yen that got rejected from the channel's trendline resistance accelerating the downside, as it actually did. We did have a decently negative day yesterday, but we have a much bigger negative day today, clearly and cleanly slicing through the 200-day daily moving average, which did act as support the previous 2 times we tested it here and there. So this time, not only we break through it, but we seem to be cleanly breaking through it, and now targeting next the trend line support of this descending channel, and there is a decent amount of room left to the downside from where we currently are, close to 150 pips to the downside before we can even discuss about further acceleration lower through this channel, which of course that would be a very bearish event because it would negate the corrective pullback prospect and would open the door for a much bigger move to the downside. Even if that would prove to be corrective, it would definitely be of a much greater magnitude than the one we initially seemed to have in hand. Now, another technical thing to mention is that the dollar has turned higher once again and is once again testing this trend line resistance, right? So we got rejected last week from it. We got rejected from it like 3 weeks ago, and we're back testing it once again here. Now, admittedly, the fact that we keep knocking on the door and every time the sell-off from the rejection is smaller and smaller gives credibility to the short-term bullish outlook for the DXY, and we might as well in fact end up seeing a break higher from here, which, as I've said multiple times, that would then open the door for 94.50 to 95 for this corrective move to unfold further towards these levels, and we can reassess when we get there if we do break higher. Now, of course, counter argument to that, or the other side of the same coin, is that from a risk reward perspective, being short here against this trend line resistance, which is just a few pips away, makes a very good technical opportunity because you're risking very, very little, and if we indeed we get rejected, you get to benefit from the potential downside from there. But the way price is behaving, and if we do close the day by forming, because we're currently forming also a morning star formation, right? The combination of Friday's candlestick with yesterday's candlestick with today's candlestick, if it closes like that, they constitute a morning star formation, which is a nice bullish reversal candlestick formation. Generally works decently. Nothing works 100% of the times, of course, especially when we're talking about candlesticks, because they by definition they have more short-term they're more like short-term indicators, and indicators you should usually use in combination with other stuff, but in any case that's worth mentioning as well. So Aussie yen was one thing I wanted to mention. I did. Aussie, Kiwi in general I did. The DXY, which I did. Now the other one I wanted to mention was crude oil, because we talked specifically yesterday about crude oil when it was trading below this trend line support from the potential symmetrical triangle, and I said that if we break below it, then we're targeting this channel's trend line support, because then this gets transformed to a channel. And I said if we do close lower, because last week we made another attempt and we never closed lower, and the same thing happened yesterday, meaning we pared back the vast majority of the losses by the end of the day, and we didn't end up closing positive, but we ended up closing slightly negative and within these triangles boundaries, which means that we still haven't had even this short-term bearish development. Of course, that doesn't mean that we won't have it today, but it's worth noting that we ended up holding within the triangle, and we're still holding. And even if we break lower, this is going to be the third time. That doesn't mean, you've already seen it twice during the past few days. There is no reason not to say, for a third time, we might once again pull back by the end of the day and close back within it. Now, undoubtedly, in the short term, crude does remain, it looks heavy, right? And it's definitely within some type of a corrective move. But on the other hand, this market, especially given the magnitude of the move from 11, if we're talking about the continuous to 77, so a sevenfold increase in the price, only the fact that after a sevenfold increase in the price, we're managing to hold up so nicely in a corrective move lower, I think says a lot. Now, natural gas is trying to invalidate yesterday's rebound from that horizontal support resistance area, clearly a break below it, meaning a break below 380 is going to be important, because then it's going to open the door for a deeper corrective move lower towards 340, right? So keep that in mind. Against 380, risk reward is in your favor to be in the long side. Below 380, I think we should be looking for a deeper corrective move, one towards 340. Natural gas, also an instrument that has had a massive increase in price. And at some point, as we had said multiple times, yes, would have a deeper corrective move lower. Perhaps this is the one, right? In any case, 380 is a pivot area, and only below it we can start talking about this deeper correction and how it might unfold, as I said before. Now, one last thing having to do with the FX world I wanted to talk about has to do with cable. We were talking specifically yesterday about how cable still holds nicely within what looks like a corrective channel. Now, today's sell-off is a rather strong one, and it threatens with a break below this trend line support. Of course, extremely early on the day to claim that's the case. I mean, it's extremely easy for the pair to slightly pull back by the end of the day and close within it, but it is definitely one of the charts that I will be paying attention to closely. I'm very interested to see how we close the day in this case, having to do with the euro. I've stressed out the importance of 117, the 38.2, and the previous low here. A break below it, I think, is clearly going to open the door for more losses, and of course, at the same time, that's also going to mean the break of the DXY through this trend line resistance we were talking about, and the move towards 94.50, 95. I mean, it's more or less one and the same. Now, yesterday, oh, what a surprise! By the end of the day, we pared back all the early losses, and we ended up producing, speaking about the S&P, because it's always the preferred instrument to monitor if you want to be looking at one stock index, to get a broader idea of risk. That should, in any case, be the S&P. I've explained the reasons multiple times in the past. And guess what? We ended up producing, instead of a very negative candlestick, we ended up producing an outside hammer, which is definitely not a bearish candlestick, if you want to interpret it in a way. If not by, the most conservative way would be saying this is a pin bar and this is mostly an indecision candlestick, but more specifically it was a hammer. So if you want to give it a bearish or bullish spin, you have to give it a bullish spin in this case. Now we're making another early attempt of a sell-off, exactly as we made yesterday, right? Now, clearly, as you understand, the music isn't over until the fat lady sings. I think that's the expression. So I'm going to have to say again that the day is not bearish until the daily candlestick has closed, and it's a bearish one, right? We've seen the resilience, the brainless resilience of these markets and the resistance to sell-offs. Right. So, before we jump the gun to the downside, let's first manage to get a bearish candlestick post pre-market session, and by the end of the closing day, and then we can talk about it. In any case, yes, at some point we're going to get a sell-off. The next upside target, which we didn't make it to hit yesterday, and so far we're far away from doing it today, was the 4,493, which is the 161.8% extension of the latest micro sell-off, because we don't have sell-offs anymore. We have like mini and micro sell-offs. And we're still obviously within this larger ascending channel that has been developing since the end of October, right, of last year, clearly. And for any technical breakdown to take place from here, we would need to break through 43.80 because that's where the trend line support passes from as we speak. So unless we break through 43.80, there is really no technical development we can talk about that's going to be bearish. Even if we have like a very bearish day today, if you're really looking for technical developments above short-term time frames like the 1 hour chart, the 2 hour chart, the 4 hour chart, then you'll have to at least see a move below 43.80, and that's going to open the door for a deeper sell-off, which, yes, at some point has to happen. Let's hope it happens sooner rather than later. We all want to see some proper increase in volatility. It makes our lives as traders much better, but unfortunately, it's not within our powers to make it happen, right? We just monitor and hope for the best. Amira, as I see, is asking for the QQQ, which is the Nasdaq. Speaking about the Nasdaq, you'll see that the Nasdaq has been somewhat underperforming the S&P, meaning it hasn't been producing higher highs for quite a few weeks now. So that's something worth noting. You can also make the technical claim that it has broken through a shorter term, though, ascending wedge than the one we're monitoring in the S&P. So, the technological stocks have been the ones that most of the times have been leading the rally higher. Somebody can make the claim that perhaps now they're opening the door and leading the way for a deeper corrective move lower, testified by the fact that the Nasdaq seems to be breaking down before the S&P does. And, I don't have a counter argument to that. It might as well be the case, right? But as I've said before, I think that if you want to have confidence in your outlook in stocks, if you want to be looking at one and only one instrument that's of great importance, that would definitely have to be the S&P. And in regards to what the S&P is doing, we have not broken down yet. Okay, now we end up breaking down. At least the positive thing is that I think this market is so stretched and sentiment is so one-sided, and likely positioning is also so one-sided, that there is a very decent chance that you're going to see a sharp sell-off and a very decent follow-through. So, even if you want to be conservative and wait for that breakthrough the S&P trend line support we were showing before, I think there will still be more than enough of a downside left for you to take advantage of. So yeah, that's one thing I wanted to say. Now, if you want to have a look again at the VIX, as we said, there is this divergence in the VIX, right? Very, very obvious divergence. Previous low in the VIX was at 14. This low in the VIX was at 15. So a clear divergence. And having to do with the VXN. Now, that is weird. It's rare that you see this type of divergence in this type of markets. Usually you see the opposite. In the case of the VXN, we had the opposite type of divergence, meaning we kept getting lower lows in the VXN while the Nasdaq was actually failing to produce higher highs. And usually this is not the type of divergence you're seeing in so overstretched bullish markets. Usually you see the opposite type of divergence. Okay. Anyhow, I think this concludes by the way, no big changes having to do with gold and silver, no changes since yesterday. There was one more thing I wanted to mention though, and I almost forgot, and it had to do with platinum. Because among the rest of the metals, there is no real development worth mentioning. There is one in platinum though, because platinum seems to be breaking through this trend line support. And you see that it is quite important, right? Because it dates back to the to March of 2000. March, what was it? March of 2020. So it is like, what is it? Like a 16, no, more than 17, 18 months trend line support, 17 months old support. No, 18 months old support. And we seem to be breaking through it as we speak. And that is definitely a bearish development, and at least in the very short term. We confirm that by the end of the day. Then the next downside support you should be looking towards should be, there, right? 23, 25. So with the exception of platinum, which I'm not saying it's not important, we don't have any real developments in the rest of the metals. Platinum, with palladium, sorry, with the exception of palladium, platinum keeps trading within this descending channel. Gold had a very, very nice rebound, but still trades within this descending channel. So no bullish breakout yet. A very nice reaction, but no bullish breakout yet. And silver has had a reaction from $23, but definitely far away from breaking out. The first area it should break out from would be this descending channel, the resistance of which currently passes from 24.80. So we're definitely some distance away from it, a little bit more than $1 to begin with. So yeah, I think that concludes everything I had to say. And now I can go through some of the questions. Okay, previous comments were for Blake. What price is the bottom of that zone? Sorry, I didn't see your question when you posted it. So if you can tell me instrument. Then there was the question of about the Nasdaq. I already covered that. SPX has mostly stayed above the 21 moving average on the weekly chart. Yeah, Bran, I have no objection to that. But personally, I'm not so much of a believer of moving averages. I mean, I think that if you are to monitor one, it would be the 200 DMA because it's the most acknowledged, and that mostly for reasons of looking at the same instruments that other people are looking, right? So it's mostly because of psychological issues, you know, that the rest of the market participants are looking at that. So perhaps it gains some significance because other people are also looking at it. But having to do with the rest of the moving averages, I don't pay that much of an attention. Irrespective of that, I do keep a 50 daily moving average as well, because, you know, just for comparison of the behavior between a slow moving average as the 200 DMA and a faster one as the 50 DMA, because, you know, their inclination, the relationship between of them makes it very easy for your eye to catch, you know, momentum type of events by looking at the chart. Not that I consider the 50 DMA to be some kind of a magical line, you know, that does wonders or anything. But as I said, since I do keep a slow moving average on my charts because a lot of people are looking at the 200 DMA, that's the reason I also keep the 50 DMA to have a faster one as well. Now I know that some people are looking at specific EMAs, right? Exponential moving averages. Some other people are looking at different moving averages. The 21 is somewhat popular along with the 101 outside of the 50 and the 200 I already mentioned them in. But I really don't think that these lines have any magical significance. I don't think that, as I said, I think that the only important one is the 200 DMA because a lot of people pay attention to it, not for any other reason. Bran says, yes, I've heard that before, and it's getting me towards price action. MAs are sloppy, but still an indicator. Yes, yes, absolutely. Absolutely. They are an indicator, and you know something? A lot of things are working in trading as long as you build your methodology around it, right? And many times, the only thing that technical rules, technical analysis, irrespective of which technical analysis type we're talking, rules do for us, which is extremely positive, is that they impose structure. You know what I mean? They impose following specific rules, which you know, make you act more in an automated way than a sentimental way, which is always a good thing, right? Because, you know, ideally, you would want to plan your trades and do your trading in a way that emotions have absolutely nothing to do with it. That's the ideal situation, right? Emotions can only lead you to make mistakes. Or even if they lead you to make sometimes the correct decision, statistically speaking, emotions will lead you most of the time, more of half of the times to take stupid decisions than the opposite.
Awesome.
Yes, I hear you. I literally do Tai Chi right before I start to trade. That's actually great. You know, anything that works for anybody in
yeah,
you know,
it's great to
in
have a process. Yeah.
yes, meditation or whatever. Anything that builds your mentality more one of a robot's mentality than one of a human that is looking at the P&L and is like, oh, I'm making money, oh, I'm losing money, or whatever. It's positive for you. Okay, any other questions, guys, gals?
Thank you, Steve. You were awesome as always. Give my
Thank you,
regards to
Sergio.
your family and
I
go
will.
get some go get some sea time.
See you tomorrow. Bye
See
bye.
you, everybody. Bye bye.